The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod on behalf of Gold Money, and with me on the line all the way from America is Turd Ferguson, who runs the TF Metals Report. The TF Metals Report is subtitled The End of the Great Keynesian Experiment. This is a blog for an online community known as Turdville, whose members are referred to as Turdites. If this seems a little weird, please be patient. Turd advocates satire rather than anger against the financial system. Satire is something British listeners certainly appreciate. But he also does a daily metals podcast, which is a subscription-based show. Welcome to the podcast, Turd.
Alasdair, it is my pleasure, and thank you for the very terrific description of Turdville.
Not at all. Now, Turd, I'm sure some of our listeners will be reassured to know that this is not your real name and that you were not born of parents heartless enough to inflict such a cruel joke on you. Or does it mean peace in the Navajo language?
Yeah, exactly. It's an old Comanche Indian name. And yes, it used to be O. Ferguson when we came over from Ireland years ago. No, it's nothing like that. I've actually grown up here in the American Midwest. When I first, got involved in the gold and silver community some years ago, it was at a site called Zero Hedge, which I'm sure many of your listeners are familiar with Zero Hedge.
Indeed.
And when you sign on and become a member at a website, you often have to pick some anonymous name because everything's anonymous. And I had just seen a Saturday Night Live skit from 10 or 12 years ago in which one of the characters is named Turd Ferguson. And so that was on my mind for some reason. At the time, I was searching for an online name at Zero Hedge, and now I'm stuck with it. Had I known that all of this would grow to such this huge thing, I certainly would have chosen something more glamorous.
Well, it's certainly distinctive. Let's leave it at that.
Okay.
Anyway, Turd, if I may call you thus. The Keynesian experiment. I think I know pretty well what you mean by the end of the great Keynesian experiment. But in your own words, what actually are you referring to?
Well, a decision was made to crown Keynes the king of economic thinkers some almost 70 years ago, 80 years ago, and we've been down this road ever since. It really started speeding that way during the Great Depression here in the U.S. and global depression, really, of the 30s. Once the decision was made to make the U.S. dollar the world's reserve currency at Bretton Woods, it started speeding faster down this Keynesian road. And once Nixon closed the gold window in 71, the Keynesian vehicle began rambling out of control. We've now reached the end of the feasibility of growing the debt. There was a while where I guess the Keynesians thought that if we could grow economies as quickly as we grow the debt, then maybe this is all sustainable. And unfortunately, we've now reached the end of the road where the debt cannot be serviced without unlimited production of fiat currency. And that is going to be the ultimate demise of the system. It was eventual. Anyone, I guess, looking at economic history could have predicted it decades ago, but we've kind of lived in denial for a while. But now I don't think, any sensible person is living in the denial anymore that this is coming to an end.
Yes. I think that to support what you're saying, my analysis of the end of the great Keynesian experiment actually was it shuddered to a halt with the banking crisis in 2008, 2009. And because that was the point, I think, where the bubbles started popping, and it was the end of a world where debt continued to expand without anyone paying attention to it and sort of thinking about the other side. Well, we're spending the money on welfare and we're spending the money on new houses, we're spending money on anything which really doesn't matter. That was, I suppose, the end of the Keynesian experiment as such, and we're now living in the sort of aftermath and trying to stop it all falling over. Would you agree with that?
Yeah, I think, Alasdair, that's actually a very accurate way of looking at it. We now have existed in this kind of, not necessarily post-Keynesian yet, but let's just call it the post-Keynesian purgatory, where we are paying for our sins of money creation and debt creation over the last 70 or 80 years in fiat currency. Someday soon, probably not voluntarily, but someday soon, the Western world is going to be dragged back into some sound money, gold-backed system, and that will be the dawn of a new era. But between the crisis of 2008 and today, yes, we've been in this kind of post-Keynesian purgatory. And and I'm not saying we're going to come out on either side, up or down, I suppose, when we get out of purgatory, but it's definitely going to be something, a whole new international monetary regime.
Yes, I think it's really left everybody in a debt trap of some sort. And that's before we look at the off-balance sheet liabilities, such as future social security liabilities, healthcare liabilities, and all the rest of it. But so far, or certainly recently, the American economy hasn't had to face this reality because the Fed has managed to manipulate interest rates down to a very, very low level. So the borrowing costs aren't ruinous. But surely that can't go on forever, can it?
No, you wouldn't think so. You think of how many people didn't think we could get this low. I'll give you an example. Here in the States, traded on the New York Stock Exchange is a very popular, or at least it was, closed-end fund with the symbol TBT, Tomboy, which is I guess, an inverse fund for 10-year interest rates. And beginning in 2009, people started buying that thing, thinking, well, certainly, given the level of money that the U.S. has to raise at $1.5 trillion a year, rates have to be going higher. And fortunes have been lost in that darn thing because the U.S. has been able to rig and manipulate interest rates lower. We are caught in a vice, and in this interest rate vice, Jim Willey calls it the black hole of Treasury markets, and that it's almost a self-fulfilling market at this point, and that everything looks terrible, so therefore we need to shun all risk assets and buy U.S. Treasuries, which pushes interest rates down further and the bond prices up higher and creates this perception that everything is terrible. So therefore, now let's sell more stock, let's sell more corporate bonds, let's sell more municipal bonds, let's sell more sovereign debt, and let's buy more Treasuries, which pushes rates down further and pushes bond prices up higher, which reinforces this thing that everything is terrible, which means we have to sell more. And eventually that Treasury market just becomes this black hole that devours everything.
But you've just described a bubble. I'm sorry, I sort of giggled slightly at the ticker TBT. I thought sort of too big to what? That all closed. I think it still trades, but boy, it was supposed to appreciate in value as interest rates went up in the U.S. Yes. Well, this could be the low point. But I think behind what you're saying is the flight to safety. I mean, this is a bubble argument, isn't it, really, in a sense? And one wonders what the level of bond yields, government bond yields would be in the States if there wasn't a worse situation somewhere else in the world, like Europe. I mean, if the European situation wasn't so dire, do you really think that US bond yields would be so low? Because, at the moment it seems to me that portfolio money that might otherwise go into the third largest economy in the world is sort of excluded from it by risk.
Well, Alasdair, you're going to a point where I might be able to slip on my tinfoil hat for a moment. It would, as an avid watcher of markets, and the dollar being the U.S. dollar index being a key component of what we watch every day, you could almost draw a connection between dollar weakness and then the point where the dollar begins to look very bad on the chart. And all of a sudden, the spotlight gets turned onto Europe to make it all. Look at all of Europe. We've seen that. I've seen this almost, let's say consistently for the past 36 months. as soon as the dollar looks weak, then all of a sudden the spotlight gets turned on Europe as to how terrible the situation in Europe is, which makes the dollar go back up. As soon as the treasury market gets weak, there's always a spate of headlines to remind us of just how terrible things are every place else to pump up the dollar and pump up the treasury market. But you're right. I mean, it is unlikely to continue, and that is ultimately that's going to be the end of the Ponzi here in the U.S. In that, right, in fiscal 2011, the U.S. interest on the national debt alone, the interest component of the fiscal 2011 budget was, well, there wasn't a budget, of 2011 expenditures was $454 billion of a reported deficit of, let's just call it $1.5 trillion. So a third of that deficit was interest on the national debt. That interest was at about a 3%, 3.5% coupon and a 4% or 4-year average maturity. If that 6% instead of 3%, we could rightly assume then that perhaps the interest would be $900 billion and the deficit would have been 30% larger, closer to $2 trillion. There's obviously a vested interest in keeping rates as low as possible in the hopes and prayers that the economy will recover and we can somehow grow our way back into a Keynesian dream. One, I don't think that's going to happen. And two, eventually rates will be driven higher and that will speed the collapse of everything.
But the recovery isn't happening, is it? I mean, that seems to be drifting even further away.
Exactly. And that, again, that is forcing them to keep rates low. That is, I mean, think about this. We were arguing yesterday, Alasdair. They were arguing on television whether the Fed would extend their language of saying we are going to keep interest rates low instead of just through late 2014. We're going to keep it low into 2015. And nobody stops and says, wait a second, that's over 2 years from now. I mean, if the language was, we're going to keep interest rates low through the end of 2012, that would be one thing. But they're talking 2.5 years, and that's not good enough? Apparently the language needs to change. No, they have to keep rates low. One, to service the debt and keep the bond market, hopefully, and keep the Ponzi going. But the economy is not recovering. We're using it, to use that kind of metaphor. We're pushing on a string trying to get it going, and eventually the system will collapse under its own weight. Again, now many of us have said that for, in all honesty, we've been saying that now for several years, and it hasn't happened yet. But it's not that the problems haven't compounded over the past several years. I mean, we're just that much closer to having an end.
Yes, never underestimate the ability of the authorities to put off the inevitable, I suppose. If I can turn to gold and silver, now this is something which you're very, very close to, obviously, because you've got a subscription-based podcast, daily podcast, which really does talk nothing else but metals. Not that I've listened to it, but that's what I understand. How do you see the situation at the moment? I mean, gold should be doing better by some analysis on the basis of all the systemic risk and all the rest of it. How, can you give us a little bit of a feel for how you see the bullion markets at the moment?
How much time do we have, Alasdair?
Well, I've got all the time in the world, but I don't know that our listeners have.
That's one of those good open-ended questions. I could run with that one all afternoon, but I won't. Let's see, where do we start? In 2011 was a rather seminal year for what we call the bullion banks, in that the silver market almost got away from them in April of last year, and the gold market almost got away from them in August. And what I mean by that is the bullion banks have maintained long-held positions, short, and I'm like crossing my words together. They have long-held short positions.
Yes, I know what you mean.
Naked shorts, through which the primary purpose of those is to control and suppress and manage the ascent of those, to help create the image that all is well. We can maybe talk about that another day. But nonetheless, those short positions were in danger of really causing problems for them. And in April of last year, there was a panic amongst the silver bullion banks as there was a genuine supply squeeze developing. And then after the U.S. was downgraded by S&P in early August of last year, the same thing happened in gold. The period since has been in my view, a manufactured paper price decline through which the bullion banks have been able to eliminate a large part of their net short position. In silver, the net short position of the silver banks has been decreased by almost 80% May 1st of last year. So you think, okay, well, silver's down almost 50%. Well, why? Well, to me, it's been driven down so that these banks could cover those short positions on the way down and do it at a cost-effective basis. Now that they are almost out, and the net short ratio of those big banks is almost down to 1-to-1 in silver. Now that they're almost out, soon price will rise. We have been in a trading range, a long, technically solid basing trading range in both gold and silver since early May. So we've been at this for 90 days. In gold, the range has been roughly between about $1,530 and $1,630, about $100 range. And silver, with some exceptions, has been between 27 and 29.
Right. Yes, that's interesting. I noticed also that the managed money in silver, if you go into the disaggregated data from the commitment of traders disaggregated data, the managed money has got record short positions, and I would take that as a contrary indicator. Would that be valid, do you think?
Absolutely right. And again, that's part of this cartel short covering strategy, and that they have now they were at tremendous risk last April. They have transferred that risk from themselves to the managed money. Do you see what I mean?
I do indeed, yes. That does make a lot of sense. So we have a potentially, if you're right on this, a situation where if a squeeze starts on the managed money, some people could begin to front run it and even make it worse for them.
Yes. And really squeeze them. And if you think about a short position, again, managed money is very happily long or short, usually just based off of momentum. Well, you're short, you're -1. To move to long, you got to get to +1. That involves buying 2 contracts. So it's potentially very explosive as that managed money moves from short to long, because you purchase one contract to cover your short and then you purchase another to go net long. So there's a lot of, and again, it is, yes, you're right. It's almost a contrarian indicator to get the managed money that short, but it is a very, very big indicator of potential price explosion to come. And I'm extremely bullish. Couldn't be more excited. My main advice to folks is to not necessarily trade, because the markets are so manipulated that you're likely to lose in the short term. The main thing is just to keep stacking. Buy the physical metal, gold and silver. If you have to ask yourself if you have enough, you probably don't. And take delivery, hold it in your own 2 hands, put it in your own safe, or dig a hole and bury it in your own backyard. But buy physical gold and silver and hold it for the future. It is your only protection against what is most assuredly coming.
Yes, and this is exactly what some central banks seem to be doing as well. They're moving out of paper money into gold. I mean, most noticeably, central banks on the Asian continent, and I would include, obviously, China, we all know about. India bought a whole load off the IMF. I wonder if they were ever given delivery. Probably not. The Russians are quietly accumulating as well. And all the countries in that sort of political sphere of influence are all building their gold reserves. And I can't help but feel that this is something which isn't really being noticed enough in the West, and it's not getting the publicity that perhaps it should. Is this something that you find that people do notice in America, or are they completely oblivious to it?
Well, on balance, they're completely oblivious, just like they are to most everything that's going on around them. However, it is absolutely true. One, you can imagine that is, why wouldn't they be doing that? You're sitting on literally trillions of dollar reserves, and you can see the writing on the wall if you're in the Chinese government or the Japanese government or the Indian government or the Russian government. Why would you not be moving that? Not even all into gold, but into art and real estate and any other hard asset you can put your hands on. But one of the benefits that I have of being Turd is that I've been able to make some very good friends around the world. One of them is an Englishman by the name of Andrew Maguire, who is very close to the London physical market. And Andy assures me on a regular basis that the amount of metal that is flowing from London to points east is astounding and underreported. In fact, when we saw a number, I guess it was just last week, where the Chinese said that so far year to date, they have imported 315 metric tons of gold. Andy's words were, that's just the amount they can't conceal.
That's very, very interesting. I certainly remember Andrew Maguire because he spoke at the Garter conference in London last August, about a year ago, and he created quite a stir, I seem to recall. So, yes, I mean, he's very much known, I think, as someone who is extremely close to the situation. So that's a very interesting tidbit. Changing tack just slightly, I had a look at your blog, and I see that one of your bloggers produced a very interesting report on silver, and this was posted on July the 30th, so earlier this week. And he was comparing grades at the Horn Silver Mine in Utah back in the 1880s with grades today. And I found it very interesting because your blogger was saying that the grades at the Horn Silver Mine were nearly 57 ounces per ton. If you bear in mind that Fresnillo, on his figures, their best mines get about 10 ounces per ton, and there's perhaps an industry average of 4 or 5 ounces per ton, and with very high energy costs, it seems to me that is this peak silver, do you think, or is the worry unfounded? Because I think there's meant to be quite a lot of silver left in the ground at these very low grades. But will it ever be mined, do you think? In other words, what is the longer-term supply situation, do you think, for silver?
Well, that's a big picture question, Alasdair. No, and for clarification, yes, that gentleman that wrote that is a very smart guy. His name is Steve St. Angelo. Who has kind of fancied himself, made himself into a pretty astute silver analyst. It's like anything in the blogosphere. You can watch the BBC or NBC and be fed whatever news is there, or you can go out and find your news yourself. You can be fed reports from brokerage houses and investment banks about gold and silver, or you can go out and do the research yourself. And that's what a gentleman like Steve does. I'm fortunate that he allows me to post some of his work on our site. Getting this idea of peak silver, the amount of above ground silver from, if you go back to World War II days versus today, has been depleted by almost 90% by some of the studies I've seen. And that is because, partly because of investment demand, but because of so much industrial use. Will we continue to produce silver even at the rate we currently are? And I think that's part of what Steve was getting into in his report. And again, you can find it at tfmetalsreport.com. What he was getting into there is with the cost and with the not only of the input cost of trying to get stuff out of the ground, but the diesel costs, the energy cost to pull this off. And because silver is a byproduct usually of mining for other things, is there less and less silver available for the world to consume, not only invest in, but just to consume? I think it's a valid argument. Again, others would maybe disagree or have their own data points to look at, but I think he's onto something. Ted Butler, do you know Ted Butler, Alasdair, the American silver analyst?
Yes, I know exactly who you mean.
He pointed out just recently that if you take the average amount of money, or average amount of silver that is either mined or recycled and refined on a daily basis, and you subtract out the industrial use, you end up with about 15 contracts worth of silver on the COMEX. It's about 65,000 ounces or 75,000 ounces a day is all that's left over for investment demand. It's not very much.
So, it could, so a change in investment demand could have actually a disproportionate effect on the price.
Well, exactly. And what's interesting about the precious metals, and really it's like anything else, when they're on sale, nobody wants them. And this was all critical to getting physical demand under control and why prices have declined to the benefit of the bullion banks for the last year, because they were getting a physical squeeze, particularly in silver, and investment demand was going through the roof. Well, if you can drive price, cut it in half and kill investment demand, because it's just human nature to think, well, I don't want to buy any of that. It's come down 50% when it should be the opposite. But nonetheless, if you can kill investment demand for a while by driving price down, you can help kind of solve your problem, or at least patch it over while you attempt to extricate yourself from your short position.
Well, Ted, I think that's very interesting. And so I think in all that we've come to the conclusion that the Keynesian experiment has ended, and precious metals are probably the best protection you've got in what is now a very uncertain future. So I'd like to say thank you very much indeed for taking part in this podcast. And where can our listeners find you on the internet?
Well, the main website is just simply one word, and it's tfmetals.report.com. And the TF obviously stands for Turd Ferguson. So just one word, TF Metals Report. It's free. You can go there. You can read anything. If you want to sign up and comment and interact, you can sign up, and that doesn't cost anything either. We've also started a subscription-based podcast service where every day I go on and create a podcast that talks about the metals and trading the metals and then other news of the day. And then we bring on guests as well and have other interaction with some big names in the industry. That one is, again, one word. It's Turd, T-U-R-D, turdtalksmetals.com. And we have a lot of fun there too. So thank you for giving me a second to plug those.
No, that's very much my pleasure. Anyway, we will follow those sites with great interest, and thank you again.
Thank you, Alasdair. It's been great fun.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.